Hi everyone, and welcome to ACCA P4. This is meant to be our last live session, so we're going to continue from where we stopped last time, and whatever is left you can supplement with the videos, and as a result of that, any question that you have, you can let me know. So last time we started with the exchange rate risk, and with the exchange rate risk we said that we are going to look at the essence of transaction risk, economic risk, and translation risk. Transaction risk is in relation to a gain or loss due to movement in exchange rate when your company enter into foreign currency denominated transaction, and settlement is supposed to occur on a future date. With respect to translation, we said translation relates to the gain or loss when you have to prepare a consolidated financial statement to include a subsidiary that has prepared its account in foreign currency. And we also have what is called economic exposure. Economic exposure relates to the long-term aspect of transaction exposure, which is basically looking at the changes in the present value of the future cash flows as a result of changes in the exchange rate. So that is what we discussed last time. And we also looked at the three exposures, which one is more important to the financial manager. We simply said that those which affect the cash flows will be the exposures that the financial manager should be much more concerned about, because the financial manager is there to maximize the present value of the future cash flows. In other words, to maximize the market value or to maximize the shareholders' wealth. And the shareholders' wealth is maximized when the present value of the future cash flows are actually maximized. So they should be concerned about the transaction and the economic exposure. If we should be concerned about transaction and economic exposure, then there is the need for us to protect them. And to protect against those exposures is what we refer to as hedging. So hedging or protecting the exposure. What exposures can we talk of? We can think about the economic exposure. How can we protect or how can we hedge against economic exposure? The magic word you have to remember here is diversification. We all said that diversification has got the effect of reducing risk. So economic exposure being a long-term phenomenon, we would have to diversify. That is the reason why you might see most of these car manufacturing companies, they don't produce and sell in the same country, so that a gain in one currency will be used to reduce the loss in another currency. Okay, and that is what is called the diversification. So the magic word you would have to remember when the examiner asks you how can you protect against economic exposure is what is called diversification. Diversify onto what? You have to diversify your financing. You have to diversify the production and supply of your goods. You have to diversify purchasing of your raw materials. Diversifying financing means if I want to raise money in a foreign currency, I do not have to raise it in one foreign currency, because when I raise it in that foreign currency and that foreign currency appreciates against my currency, then paying off that foreign currency loan and its interest is going to be more expensive, because I'm going to convert my own currency, which is now depreciated, to pay off the interest and the loan. So if I want to remove that exposure or reduce that risk, all what I'll do is I won't borrow in one foreign currency. I can borrow in different foreign currencies. For instance, if I'm based in UK, I can borrow in dollars. I can also borrow in the Indian rupees, so that, for instance, if the dollar appreciates against my pound might appreciate against the rupee. and the gain I will get on the pound rupee, I will use it to combat or reduce the loss I will make between the pound and the dollar. And this is an example of diversifying your finance. Diversifying your product also here means that you don't produce in one country. You produce in different currencies, so that the gain on one currency will be supporting the loss in other currency. Don't sell your product in one currency. You can sell it in more than one different foreign currencies, so that any gain there will be used to combat a loss there. You can also use what is called currency swap. You can also use currency swap as a way of managing your economic exposure. That will be seen in chapter number 19 that you can read. What factors should we take into consideration in trying to protect ourselves against transaction exposure? The factors we have to consider here will include the fact that if I have to hedge or protect against transaction exposure, we said transaction exposure occurs when you enter into foreign currency denominated transaction, and the settlement will occur on a future date. Does it mean that the moment I enter into that foreign currency denominated transaction and then I have that transaction exposure, should I go straight to go and hedge? That is not the argument. If the currencies involved, the exchange rate between those two currencies are not volatile, the exchange rate there is not simply volatile, but the exchange rate is reasonably constant, there is no need for you to hedge, because you are hedging against the movement in the exchange rate. So if the exchange rate is just barely constant, it doesn't change. As long as I have got that transaction exposure, there is no need for me to hedge it, because that exchange rate is not going to move. You are hedging against that movement. So if that movement is not happening, there is no need for you to hedge it. When you have to hedge, you also have to use hedging instrument. And some of these currencies haven't got market for such hedging instrument. So look at availability of the market for the currency in question. You also have to obviously look at the cost involved in hedging. If the cost of hedging is more than the benefit of hedging, then obviously it is better you do not have to hedge. You also have to look at how frequently you enter into that transaction. If you enter into the transaction frequently, then there is the need for you to hedge it. If it is one-off transaction, and then why do you have to waste time, money, and other resources trying to go and protect one-off transaction? This argument can be extended. It could be one-off transaction, but what is the magnitude of that transaction? So if it is one-off transaction and the amount involved is very small, is immaterial, there's no need for you to hedge it. But even if it is one-off transaction and the amount involved is very, very big, huge amount, then you cannot say I have to forget about that. So also look at the magnitude of the amount involved, because if the amount involved is big, if you have to make exchange losses, obviously it's also going to be big, and it will affect your company's market value through the cash flows. You also have to look at your attitude towards risk. Some management, they are simply risk averse, and being risk averse, they will want to protect it. Some managers are risk lovers. They will tell you, forget about it, let's take our chances, and as such, leave it. The exchange rate might move in our favor, so let's leave it as it is. So also look at your attitude towards risk. Now let's go straight to how to protect against transaction exposure. To protect against transaction exposure, we have got two methods. What are the two broad methods? We've got the internal techniques and we've got the external techniques. The internal techniques will include invoicing in your home currency. Okay, what do we mean by invoicing in your home currency? If you go back to the definition of what is called transaction exposure, we said transaction exposure occurs when you enter into foreign currency denominated transaction, and the settlement will occur on a future date. So when I enter into the transaction in my home currency, it means the transaction in the first place is not a transaction exposure because it is not denominated in a foreign currency to me. It is what denominated in my own world currency. So if it's denominated in my own currency, then straightforward, I haven't got any transaction exposure, and as such, I have protected myself in the first place. And this is what I normally tell students. This is the ACCA hedging strategy. ACCA hedging strategy is that wherever you are in the world, if you are making payment to ACCA, you would have to make the payment on the basis of pounds. If ACCA want to refund any monies to you, they will refund it in the form of what? Pounds. So all their transactions in their home currency, which is the pound, you have got the exposure because you have to convert your home currency in order to come and pay the pounds. If the pounds appreciate or depreciate against your home currency, you might be called upon to pay more or pay less, and that is what is called transaction exposure. So in order to avoid a transaction exposure in the first place, I will not even enter into the transaction denominated in a foreign currency. Is it a good method? It is a good method because it will what? Protect you against the transaction exposure. The other side of the argument is that if the customer also want to protect itself against what? The exposure. If you want the customer to pay you in your home currency, then you shift the responsibility on the customer. Just as I use the ACCA as an example, if you are in another country, ACCA is shifting the responsibility on you. The moment the exchange rate moves, you will be called upon to pay more or less. So you are having the exposure. ACCA has protected itself. So ACCA, it is good for them. The other side is that it might end up losing what? Customers. Because if the customer is also wanting to pay ACCA or pay the other supplier in the form of their own currency, then I will say, I am not going to pay you in your pound. I will pay you in my local world currency. And in that case, the customer might not come to you. So the argument is, you can only think of using this method if and only if you have got a bargaining power over that particular customer. You have got a bargaining power over that particular customer. In that case, the customer hasn't got a choice. So you can tell him, when I sell to you, you have to pay me in my currency. Or when I buy something from you, I'm going to pay you in my own currency. That can be great if you have what? That particular bargaining power. As I said, ACCA has got the bargaining power over us. That is the reason why we can't go and challenge them. I'm not going to pay it in pounds. I'm paying it in my own world currency because you brought yourself into the register. Okay, so that is the understanding. Leading and lagging. Leading means you would have to speed up. Leading means you have to speed up, and then lagging means you would have to what? Delay. So leading, if you expect the exchange rate to go against you, pay quickly. If you expect the exchange rate to go in favor of you, delay. That is the meaning of leading and lagging. However, everything that we do, there's an opportunity cost in here. When I lead means I have to pay early. Should I pay early, I would have to take the money from my bank account. When I take the money from the bank account, then I am losing interest. Or if I have to pay early, I would have to go and borrow the money. When I borrow the money, obviously I have to pay interest. Same way lagging. If I delay and I don't pay my suppliers early, what is going to happen? It means I will lose my credit worthiness because I don't pay early. And as such, suppliers might not be prepared to supply me more in the future, or they will charge me extra costs before they will be prepared to do that. Okay, all these two are just what discussions according to your syllables. The only calculation here is netting. And unfortunately, netting has been tested in what? September. I'm not sure whether it's coming in December, but if you would have got a netting question is very straightforward. What is netting? Netting means you are setting off a receipt against payment. of a multinational company that is, of course, having subsidiaries in many countries, and those subsidiaries are trading among themselves. So as long as they are trading among themselves in different currencies, then there's the need for us to what? Net it, okay, by setting who is owing whom. So if A is owing B, then instead of we paying this and paying that, we set the two together and we pay only what? The difference. So netting is setting off the receipt against what? Payment of a multinational company that is having subsidiaries over the world trading among themselves in different world currencies. We've got two types of netting. We've got bilateral netting. Bilateral netting means only two companies are involved. Multilateral netting means there are more than two companies involved. So let's take this example to illustrate netting. Okay, a group of companies controlled from the USA has subsidiaries in the UK, South Africa, and France. At 31st 12x3, intercompany indebtedness were as follows: debtors, creditors, amount, UK, South Africa, UK, France, France, South Africa, South Africa, UK, South Africa, and France. It is the company's policy to net off intercompany balances to the greatest extent possible. The Central Treasury Department is to use the following exchange rate for these purposes: US dollar 6.126 rand, 0.6800 pounds, euro 5.880. Calculate the net payment to be made between the subsidiaries after netting off intercompany balances. As I said, when you get netting calculation question, it is a very straightforward question. Okay, we are going to set receipt against what? Payment. So the common sense here is, before you can set two things together, you would have to bring them to the same base. So I cannot deduct dollars from pounds. I cannot deduct pounds from, let's say, euro. Before I'll be able to do that deduction, addition and subtraction, I would have to what? Convert all those currencies into one currency. So when there is netting, there are two stages. Your first responsibility will be all the cash flows there are supposed to be converted to one currency. The question is, which currency should we convert it into? You would have to read the question. The question might tell you that, okay, convert them into pounds or convert them into this currency. If the question doesn't take a stand, then the examiner will be hiding it, telling you that the currencies are supposed to be converted into the currency of the parent company, which we normally call it the presentation currency. For those who have done P2, you appreciate this. As there is a group, all the cash flows or items of the group are supposed to be brought into the currency of the parent company, because the group will present accounts on the basis of the currency of the parent company, which is the presentation currency. So if the examiner don't give you specifically the currency you should convert into, then the argument here is that you would have to what? Convert it into one base currency. So here, given this question, the examiner didn't tell us which currency we should convert into. But when you read, these companies are controlled from the USA. So the parent company is based in the US. If it is based in the US, then all these currencies are supposed to be converted into what? The currency of the US, which is the dollar. So when you convert all of them to one currency, then you are going to set off against. And when we have to convert, we need what? Exchange rate. They've given us those exchange rate, so we have to use those exchange rate to convert those currencies into what? Dollars. So the first currency here is 1.2 million rand. So I have to convert the rand into dollars. The rand dollar exchange rate is 6.126. That is why if you come here, that money is converted as 6.126. The second one is in euro, 480. The dollar euro rate is given here as 5.88. Don't question the question. That's what I normally say. Don't go to the exam room with your own question. We all appreciate that euro to the dollar outside currently in the market is not this rate, but that is what the question says, so that is what you have to follow. Okay, so it's 5.88 euro to $1 dollar. So you divide by that and you get these in dollars. So netting is easy. First, convert all those currencies to the base currency. And the second one is South African rand of 800,000. Divide the 800,000 by that to get this. And then you will get 774 at the pound. Convert it at the pound exchange rate, which is that. And this will give you that. And the last one is euro. So 375, convert it at the euro, and you get this dollars. When you get all these in one currency, you are going to set receipt against payment. So the next question is setting the receipt against payment, which one is paying and which one is receiving. ACCA normally want us to present it in a tabular form, as we have done here, in a tabular form. Sometimes instead of saying the tabular form, the examiner is going to say you have to prepare it in a matrix form. Instead of a tabular form, they will say do the netting on the basis of what? The matrix. Okay, so all what you have to do is you have to create two columns broadly, one for paying subsidiary and one for receiving subsidiary. Argument is, if it is paying subsidiary, you have to read down. We are reading it this way. If it is receiving subsidiary, we are reading across. So across means this way. So if I do UK, South Africa, and France, those are the three companies involved. The same way I come and do UK, South Africa, and France. So when I read down here like this, it means UK is paying. When I read across like this, it means UK is what? Receiving. So that is the argument. So let's move on. So I have got my paying subsidiary. I've also got my receiving subsidiary. Okay, the first one is the amount involved is giving us 195,886. It's between UK and South Africa. So we have to establish which one is paying and which one is what? Receiving. Okay, according to the question, UK is a debtor and South Africa is a creditor. Be with me because there's slight confusion here. UK is a debtor and South Africa is a creditor. The question is debtor and creditor, who pays and who receives? Most people confuse, but the answer here is, if I am your creditor, it means I have sold something to you on credit, and as such you are my debtor. So if you are a debtor, you would have to pay the creditor because the creditor has sold something to you on credit. That is why if you are preparing your financial statement, you will say that if somebody is your creditor, you will put it as the liability side. That is what we normally call payable. That's why it confuses people here. So when somebody is your creditor, you put that person under liability. Why is it under liability? Because you have the obligation to pay that person. If somebody is your debtor, you put it as part of your asset because you have the right to receive what? Money from that person. So a debtor pays and a creditor receives. A debtor pays and a creditor receives. So when I come here, UK is going to pay, South Africa is going to receive. Therefore, this is UK paying, we're reading down. So you read down like this, and then South Africa receiving. South Africa receiving, you read across. Where do they intersect? That is where they intersect. That is the reason why you see the money being put at this point. This place is zero because UK can pay and UK can receive. So that intersection will be zero. So UK paying, you read down. South Africa receiving, you read across. Where they intersect is where you have to put the figure. The next one is UK is paying France because UK is a debtor. France is a creditor. So UK paying, you are reading down. France receiving, you are reading across. That is why this figure came here. Next one is France is paying what? South Africa. So France, if France is paying, we're going to read down, and South Africa is receiving. We're reading across. This is where it intersects. You put it there. And then you ask the question again, what is the next? The next one is South Africa paying UK. If South Africa is paying UK, South Africa is paying, so you have to read down. UK is receiving, you have to read across. That will be the intersection. That's why the figure is there. Then last one is South Africa paying France. South Africa is paying, read down, and then France is receiving, read across. This is where it will intersect. You have allocated all of them. All the other places you are putting dash or you are putting word, a 0. When you finish, what will be the total payment for each of the subsidiaries and what will be the total receipt? So UK paying, we said we are reading word down. So UK had paid this to South Africa and this to France. So total UK payment is going to be this amount. Okay, and total South Africa payment will be this plus that. You are reading down total France payment, this and that, and I mean this and that, and then you will come and get that. Then go and sort out the total receipt too. Total receipt, you are reading across. So when I come to UK received this. So the sum of that is equals to that. So UK just received only this. That's why its total receipt is that. And then South Africa received this and that. Total will give you that. France received this and that. Total will give you that. Netting, you can mark yourself. At the end, your total receipt should be equals your total payment. So when you sum up this or you sum up this total payment, is equals to that. When we finish, we would have to set off the payment against receipt. That is the reason why when we got the total payment here, the total receipt we've got here will also be brought down here. So your total receipt we are transferring so that we can set off the receipt against payment. So bring your total receipt, and the total of it overall will give you this, so that your total payment overall, your total receipt overall will add up to be equals to what? 0. Then sort it out for each of the subsidiaries. UK paid a total of that. It received a total of that. Therefore, there is a net payment of that. If it's a net payment, you put it in bracket. South Africa paid a total of that. They ought to receive a total of that. So there is a net word receipt. Here too, the same thing. Here they pay that and they receive this. This one will give you 14,818. So when you finish, the sum of the receipt here, net, should be equal to the sum of what? The payment. So what have we done? UK is now supposed to pay net of 135,877 to South Africa, and UK will also pay to France of 14,818, and that is the end of it. If we didn't do netting, look at the number of transactions we would have done. We would have done 1, 2, 3, 4, 5. And whilst we are transferring the money, UK transferring to South Africa, South Africa transferring, all of them will involve what? Transaction or transfer costs. And that transfer cost will reduce the company's overall benefit. Therefore, netting reduces transaction costs. So the only transaction that will happen will be UK paying South Africa and UK paying what? France. Is going to be only 2 transactions instead of what? The 5 transactions. And we're saving transfer costs of what? 3 transactions. And that is basically netting. As I said, unfortunately, he tested it in the September exams. So I'm not very sure whether it should appear in the December exams, but it should appear. All what you need to do is convert all the currencies into one currency, prepare the matrix by setting off your receipt against what? Payment. At the end, the total should be equals to what? 0. That is basically netting. Now let's move on to matching. What is matching? Matching, I know at F9 level, or some textbooks confused with matching and what? Netting. Some textbooks says that matching is the same as what? Netting. From English point of view, that is perfect. But when we come to P4 and hedging, technically netting and matching are slightly different. Even though all of them, you are setting off receipt against what? Payment. But with netting, specifically relates to a multinational company that is having what? Subsidiaries trading among themselves. Matching is you setting receipt against payment. If it is just a single company that is entering into a payment transaction in a foreign currency, and that same company has what? A receipt in that same currency. I am just a UK based company. I buy raw materials from India, so I have to pay rupees. I also what? Sell my goods to Indian companies. I have to receive rupees. Therefore, I have got rupee receipt and I have got rupee payment. What should I do? I can set the rupee receipt against the payment. The difference is what I would have to bring into my country. And what other companies even do is that they will open a bank account in that particular foreign currency. So all my rupee payment will get out of that account. All my rupee receipt will go into that account. Every year I am keeping that rupee balance, and that will lead me to transaction or translation exposure, because at the end of the period my bank account balance in rupees are supposed to be brought into my statement of financial position to prepare my consolidated financial statement, and that is going to create a translation exposure. That translation exposure is paper accounting movement, and as such it has got nothing to do with cash flows, and it has got nothing to do with my value of the company. So matching set receipt against what? Payment of the same foreign currency. But this one is not involving multinational. This one is not involving multinational. So that is the case. Let's look at the external techniques. We have forward contract, we have money market, we have currency futures, we have currency options, and we have currency what? Swaps. Okay, this chapter looks at these two. Other chapters will look at that, which I've recorded all of them. Make sure you've gone through them, and then any questions that you have, you let me know. So let's look at forward contract. What is forward contract? We said forward rate is the rate that is determined now, for which the actual exchange of the currencies will happen on the future date. So if I'm worried about movement in what? Exchange rate between now and that future date, I go to the bank today and enter into the forward contract and fix the forward rate today for the exchange of the currencies on a future date. So let's go and take figures to illustrate. Forward contract, the maximum max you can get there is probably 1 or 2. The maximum max is probably 1 or 2. So let's take this example. Consider the following exchange rate. I have bid dollar/the pound, bid and offer. Spot rate, 2-month forward, 3-month forward. A UK company is expecting to receive 100,000 in 3 months' time from the goods supplied to a USA company. What is the sterling receipt if the company decides to hedge using a forward exchange contract? This one, for instance, you can think of only 1 mark. Okay, my company is based in the UK and it is made sales to a company in US and is expected to receive what? $100,000 in 3 months' time. Have I got a transaction exposure? Answer here is yes, because the transaction is entered in dollars. I am based in UK and my currency is pounds, so the transaction is denominated in dollars, which is a foreign currency. Is the settlement happening now? Settlement is not happening now, but the settlement is happening on a future date, which is 3 months' time. So what will I do? I would have to think of hedging it because between now and the 3rd month, the exchange rate will be moving. And if the exchange rate moves, I might make a loss or I will make a gain. And that is what is called a transaction exposure. One way I can protect this is that I can enter into forward contract. Which forward contract should I enter? They've given me 2 months. They've given me 3 months. The one I would have to enter should be the one that is consistent with my requirement. My requirement is the money will be received in 3 months' time. So I have to enter into 3-month forward contract and fix the rate now that we are going to use in 3 months' time to exchange the dollar into pounds. So I will enter into the 3-month forward contract. And when I enter, do I need a bid or do I need the offer? Because they've given us 2 red. And we said that whether the bid or offer is dependent on the base currency. The base currency is the currency after the slash, which is based here on the basis of the pounds. So the pound is the base currency. If the pound is the base currency, this dealer is saying he will buy pounds from you at the bid. He will sell pounds to you at the offer. He will give you the pound, offer you the pound at the offer rate, meaning selling. So the basis is on the pound, which is the base currency. That's why they call it the base currency. So if I go and get $100,000 and I have to convert the $100,000 into pounds, I will go to the dealer with dollars. Dealer says I buy pounds at the bid, I sell pounds at the offer. Will the dealer buy pounds from me or will he sell pounds to me? I went there with dollars. I need pounds. Therefore, the dealer will sell pounds to me. So the dealer will offer me the pound. That is why you see them using the offer rate. And therefore, whatever the exchange rate will be, because we have already agreed this 1.550, whatever the exchange rate will be in 3 months' time, we are not bothered about that. And as such, we have a guaranteed receipt. That's why they said guaranteed, because you have fixed the exchange rate now for the purpose of exchanging the currency in 3 months' time. Whatever the exchange rate will be in 3 months' time, let it be. You are not bothered about that. You are simply going to take effect of the fixed rate that you fix in the forward contract. So that is basically that. Let's take example 9. A company expect to receive 10 million in 2 months' time. Exchange rate are as follows: spot 1 month days, 2 month days, 3 month days. Required: show how forward contract can be used to hedge the exposure. Okay, show how the forward contract can be used to hedge the exposure. I have to receive 10 million in 2 months' time. So I have to enter into 2-month forward contract. With 2-month forward contract, this is it. But the spot rate is giving us 1.6100, and the 2 month, have you seen that this here? When we did the calculations last week, we said the forward rate sometimes can be given to you as a point. And that point quotation for forward rate is a deviation of the forward rate from the spot rate. We illustrated it last time. I can't go and use $400 is to £1, and then, or let's say $600 is to £1. It doesn't work like that. The exchange rate is basically like this, the dollar slash the pound. That is what they are implying there. Okay, so therefore it is your job to first convert the point quotation to outright quotation before you will be able to use to do that. So first, the forward rate as outright is what they found the difference between the two to give you the point. So when I've been given the point and I want the forward rate, I pick the spot rate and I will either add or deduct depending on whether it is at a premium or it is at a discount. Here they said discount. So I showed you if it's a discount, a currency at a discount means you need more. So in discount terms and currency, you would have to add. And I told you it's opposite to our normal day-to-day meaning of a discount. Normal day-to-day meaning is you what? Actually, that's discount deducting. But here, if it is discount, you add. If it is premium, you deduct rather. So the argument here is that we will say spot rate 1.6 100 to 1.6400. 2-month point, they said discount. And I told you how you would have to add it. You have to start writing from the right hand side towards the left hand side. And we're going to say that this is 004. So I'll start 004 0.0. This is 600. So 0060.0. And because it is discount, we are adding. And when you add, you come and get these figures. And then you judge. Am I supposed to use the bid or am I supposed to use the offer? We are going to receive 10 million. If I receive 10 million, I would have to what? Convert it into pounds. When I went there, the base currency is pounds. Dealer says we buy pounds at the bid. We sell pounds at the offer. So if I go there with my dollar, the dealer will give me pounds. There's no other English word apart from you saying the dealer will offer you the pounds. So use the offer rate. And that offer rate of 1.7, what will be your guaranteed sterling receipt? And that is basically that. Now let's look at the next example. The exchange rate for dollar and sterling. Okay, spot 3-month forward. A UK company is expected to pay 1 million in 3 months' time and wish to fix a rate for the transaction. Required, use forward market contract to hedge this exposure. Okay, what am I supposed to do? I have to receive 1 million in 3 months' time. Sorry, I have to pay 1 million in 3 months' time, and as such, I am worried. So I will enter into 3-month forward contract. So I will need 3-month forward rate, but the rates were given in terms of the point. Once it's given in terms of the point, it's my responsibility to convert it to outright. How do I do it? I pick the spot rate and I will either have to add the point or deduct, depending on whether it is a discount or premium. Here they said it's at a premium. If it is at a premium, then I would have to what? Simply deduct, because I would need what? Less. That is why you see this one being deducted. And don't forget how we deduct. You would have to write from the right hand side towards the left hand side. So the 2400.0 and then 5400.0, and that will give you that, isn't it? And that will give you that. So what will be the guaranteed payment? I would have to judge whether I have to use the bid or I would have to use what? The offer. The argument here is I am based in UK. I have to go and pay this 1 million. What am I supposed to do? I have to convert my pounds into dollars to go and pay. So when I go to the dealer, I will go there with my pounds trying to convert the pounds into what? Dollar to go and pay. But because the base currency is the pound, he says I buy pounds from you at the bid. I sell pounds to you at the offer. I have to go there with pounds trying to convert the pounds into what? Dollar. So he will buy the pound for me. That is why you see that they are using what? The bid. And then the amount you will pay guaranteed should be equals to the 664,231. So whatever the exchange will be in 3 months time, you're not going to be worried about it because you have already fixed the rent. Okay, what is the implications of using forward contract? The implication here is that forward contract is obligatory. So when you agree on the rate, whether the market rate in 3 months time, for instance, is better or not, you cannot go and use it. You are obliged. So the bank manager will wait for you. Like this example, the bank manager will wait for you. Fred, we entered into the agreement and we fixed the exchange rate at that. So on that day, Fred is supposed to go and give the bank manager this money, and the bank manager will give you what? The $1 million for you to go and use it to pay whatever. So assuming In 4 months' time, the rate is 1.2. You cannot use the 1.2. That is why this word is there. It's guaranteed. Whatever the rate will be, we would have to oblige by that particular rate. We have to comply with it. Therefore, it is an obligatory contract. If you don't comply with it, the bank manager can enforce it through court because it's a contract that we have signed. Now let's move on to what is called money market hedge. Okay, money market. Money market is a market where we can either borrow money or lend money on short-term basis. So we are going to use the money market of borrowing and lending as a way of eliminating exchange rate. This is the common sense. When I have to receive money from a foreign currency or in a foreign currency from a foreign land, what should I do? If I want to use money market, okay, once I have to receive money, hedging is you entering into a counter activity in order to eliminate or reduce an exposure. So if I have to receive money, then I will say that, okay, if I'm receiving money, then the opposite of me receiving money is by creating what? Payment. So when I have to receive money, I will go and borrow money against the money I am going to receive. How much should I borrow? I do not have to borrow exactly the amount I am receiving, because the common sense is when you borrow, you would have to pay what? Interest. So I have to go and borrow an amount such that the amount I will borrow plus the interest on the amount over the period will be equals to the amount of receipts I'm supposed to receive. So that the moment I get my receipt, I will use it to go and pay the amount borrowed plus its interest. That is why your note is telling you here, borrow an appropriate amount in the foreign currency today. But the amount which is appropriate here is simply the amount you need to borrow so that the interest on that amount will be equals to the amount of the exposure. I normally do it this way for students, so let me do it for you so that when you go to the room you can stereotype. Because currency, either you are receiving it, either it's a receipt or what? It's a payment. Either it's a receipt or it's a payment. Okay, if it's a receipt, you start by borrowing. How much do you borrow? The amount you have to borrow is simply calculated as your exposure, is the present value of it. Your exposure, which is the amount you have to receive in a foreign currency, divided by 1 plus R. And that will give you the amount. When you get this amount that you have borrowed, you don't keep it there. You instantly bring it into your country. So how will you instantly bring it to your country? I have to convert it. So I have to convert, that's the second one. Convert amount borrowed into your home currency at spot rate. At spot rate. And when I bring it into my country, obviously I am not going to put it under my pillow. I would have to what? Deposit it. So when I deposit, I will get the amount plus what? Interest. And that will be the total amount I would have to think of. Same way, if I am going to pay, the counter of payment is to create what? Receipt. Therefore, instead of borrowing, I will go and deposit money. And the amount I will deposit is that I need to deposit an amount now, so that the amount deposited plus its interest will bring you to the amount that you would have to pay. So this one too is the exposure divided by 1 plus R. Divided by 1 plus R. And then secondly, you would have to convert your home currency. You convert home currency into the amount to be deposited. at the spot rate. At the spot rate. And then the next one will be that you need to borrow the money. The common sense is you borrow this money, you convert, you go and deposit the amount, you make the interest. At the end of the period, you get the exposure, you pay it, that is gone. So let's go to our note. We pick figures to illustrate. So I go to example 11. A UK company export goods to a number of companies in the USA and Europe. It is due to receive 100,000 in 3 months' time from the goods supplied to a US company. The 3-month forward rate is 1.4550 to 1.4600. The spot rate is 1.4960 to 1.4990. The quotation is $/pound. The interest rate available in the money markets are UK, US. Okay, the argument here is these are the interest rate in UK, interest rate in US. If you have to borrow, what should be the applicable interest rate? If you have to invest or deposit, what will be the applicable interest rate? Common sense should tell us when you are borrowing, you have to pay higher rate. When you go and deposit your money at the bank, you would have to get a lower rate, isn't it? So that is simply the argument. So if I'm borrowing in UK, I will pay this. If I'm depositing, I will get this. If I'm depositing in US, that is what I will get. If I'm borrowing in US, I would have to pay that. So if the examiner don't separate them for you, you would have to know that borrowing rate should be higher than what? The deposit rate. So what should we do here? My exposure is to receive $100,000. I am based in UK, so I have a transaction exposure. If I have a transaction exposure, how will I manage this? Using money market, as I did for you. Once it's a receipt, go straight and follow this principle. Don't go and waste time. I know some of you do it in boxes. Okay, that is also fine. It's the same thing. Okay, you start, you go there, you come there like that. It's the same thing that I have done here, but I normally follow that principle of what the main principle flow. You need to borrow the money, you need to convert, and then you need to what? Deposit. So we will say if we are going to receive money, then we are creating a liability, which is the payment. And as such, we have to what? Borrow. How much amount am I supposed to borrow? Amount I have to borrow will be my exposure of the 100,000 divided by 1 plus R. What is the R? I'm going to borrow in dollars. So if I'm borrowing in dollars, US, what is the borrowing rate? 14%. If nothing is said, the assumption is that it's 14% per annum. So if it is per annum, then straightforward, that 14%, I am not going to borrow the money for the whole period. The money will be for 3 months. Therefore, 3 divided by 12. And how much will I get? 14 by 4 there is 3.5%. So 1 plus R will give me 1.035. And how much dollars can I borrow? So 1 2 3 divided by 1.035, and that is giving 96618. It means I will borrow this money in dollars against against me going to pay this word. Me going to receive this 100,000. But that 100,000, this amount I have borrowed, I have to pay interest of 3.5. So 3.5 plus this will give me the 100,000. So now that I have borrowed, it means in US, I am owing the bank manager that I have borrowed this money from this money plus its interest. Somebody in US is also owing me $100,000. So come the end of the 3rd month, I will go and collect my $100,000, come to the bank manager. I have borrowed this plus your interest, which is equal to 100,000. I haven't got any dollar to think of. So this money that I have borrowed now from US, I am bringing it into my country. So my second stage is that I would have to convert this dollar of 96618 into pounds at what? The spot rate. At the spot rate. Okay, at the spot rate. So what will be the case? What will be the case? The case here is, what spot rate should we use? We have borrowed this money. So if we have borrowed this money, we will go to the bank manager with this money, converting that money into what? Pounds. When we go there, what is the quotation? Pounds is the base currency. He buy pounds at the bid. He sell what? Pounds at the offer. And therefore, he is going to use the offer rate. So our spot rate offer is 1.4990. So we will convert it at 4.990. So 96618 divided by 1.4990. And how much pounds will I bring into my country? This divided by 1.4990, and that is 64,455. Okay, so the argument next is, if I have brought this money into my country, you don't put it under your pillow. You would have to what? Deposit it. And when you deposit this amount, you would have to get interest. So what will be the total amount I will get? I will get this 64455 multiplied by 1 plus the interest effect, 1 plus R. If I have to deposit money in the UK, I'm going to get what? 6% for the year. But I'm investing for only 3 months. So same argument. The R should be equal to 6% multiplied by 3 over 12, which is basically 1.5%. So 1.015. And what is the total amount in pounds? So this times 1.015. And that will be 65,422. That will be 65,422. So this is the overall cost that overall amount you will receive. If there is forward market or other hedging strategies you've used, you compare all of them. For receipt, you pick the one that will give you the highest receipt. For payment, you pick the one that will give you the lowest payment. So this is basically money market. This is basically money market. Now let's go to the note. We pick the next level. Example 12. Assume the same fact as example 1 above, except that the UK company is making payment of 1 million. If the UK company is making payment of 1 million, what should we do? If you want to hedge using money market, once I have to go and make payment, there will be the need for me to create what? A receipt. And as such, I would have to go and deposit. Okay, so let's go there. That's why I've done them straightforward. Deposit, convert, and borrow if it is involving what? Payment. So I will say first, I would have to deposit. How much am I supposed to deposit? The amount I'm going to deposit is the exposure, which is the 1 million, okay, divided by 1 plus R. If I am depositing in the US, we are using the same fact as example above. If I'm depositing in US, I would have to get 11%. And that 11% is for the whole year. So I will say R should be equal to 11% multiplied by 3 over 12. So 11 by 4 is giving me 2.75. So this is 1.0275. How much money am I supposed to go and deposit? 1 million, 123 divided by 1.0275. And that is giving 9,73236. 1 minute, let me check this again. 11 by 4, okay, plus divided by 100 plus 1 reciprocal of that times 1 million. Okay, that is perfectly right. So if I have to go and deposit this money, What should I do? I have to convert money from my country. So I will say convert your pounds into this money you have to go and deposit at the spot rate. So if I have to go and pay this, I have to go and convert my pound for what? The dollars. So I am going to use the bid. So what is the spot bid rate? So the spot bid rate is giving us 1.4960. So I will come and check it at 9732236 divided by 1.1 minute, 1.4960. 1.4960. And how much pounds am I supposed to send in there? So I will say 973,236 divided by 1.4960, and that is giving 65055, approximately 9. Okay, so if this is the case, this is the amount I have to borrow in UK. So the total amount I have to incur will be this amount I have borrowed plus the interest on it. And what is the interest? If I am borrowing in UK, I will borrow at 9%. So 9% for the whole year, 9% for 3 months will be the 9 by the 4, which is 2.25%. So I'm going to have this multiplied by 1.0225. And how much will I get? So 1.0225 times 65,0559, and that will give me 665197 pounds. So this is the overall payment. So this is basically your money market. This is basically your money market. Okay, this is basically the money market. Right. So now I'm going to push you to the next level. The example there is very basic, which you can practice on the money market and the forward contract. It should be very easy. If these are the exchange rate and you have this exposure, how to use money market and forward contract should be the same as what we've done. So I'm pushing you straight to interest rate hedge, and then we look at other things in there. Okay, so let's go to chapter number 16, hedging interest rate risk. Right, we've said currency risk is coming as a result of a gain or loss due to movement in what? Exchange rate. The same way, interest rate risk is coming as a result of a gain or loss due to movement in interest rate. Now, interest rate is 10%, and in 3 months' time is when I want to borrow. So I waited till the 3rd month. When I went there to borrow, the interest rate is gone to what? 12%. What am I going to say? I will say, oh dear, if I had borrowed earlier, I would have paid what? 10%. But because I waited, I am now paying 12%. So I have lost what? Is it 2%? In other circumstance, today is 10%. 3 months time that I was borrowing, interest rate is gone to what? 6%. I will say hooray, because I have saved what? 4%. This movement in the interest rate that will bring about this gain or loss is what is called interest rate risk. So the moment you have an asset or you have a liability, that the value of that asset or liability depends on interest rate movement, you are exposed. Because the moment interest rate change, you are exposed to make a gain or you are exposed to make what? A loss. Okay, so that is the argument. So now let's go to the note and then we pick them quickly. So So this is the meaning of what I've explained. Interest rate risk, making the gain or loss due to movement in the exchange rate. Interest rate. If you have got an asset that its value depends on the interest rate, then definitely if interest rate changes, your asset value will also change. Equally, you have got a liability and then you have to pay interest on that. The moment interest rate changes, you might be called upon to pay more or you might be called upon to pay less. Okay, now let me explain this. LIBOR and LIBID. It's just the same as the offer and then the bid. Okay, LIBOR is simply the lending interbank offer rate. Lending interbank offer rate. Some terminologies, the examiner might not use LIBOR. The examiner might use interbank rate, full stop. Interbank rate means if one bank is going to borrow from another bank, like the LIBOR, if one bank in the UK is going to borrow from another UK bank, the rate that they would have to pay is what is called LIBOR. If one bank in UK is going to deposit money in another bank in UK, the rate you will get is what is called the LIBID. Okay, so as we said earlier, your deposit rate should always be less than your borrowing rate. So the LIBOR is always higher than the LIBID. The LIBOR is always higher than the LIBID. Okay, now let me explain something in the exam room. One way we can calculate the cost of debt of a company is by going through this. Some time back, we did the calculation of cost of debt, and we said cost of debt can be calculated using internal rate of return if the traded debt is redeemable, or we can use the net interest divided by the P0 multiplied by 100% if the traded debt is irredeemable. If I have got non-traded debt like bank loans and overdraft, the cost of that debt is the interest into bracket 1 minus T. Is just the net interest. This is another way the examiner might push you for you to go and calculate what? The cost of the debt. Okay, and so be with me here. We said the LIBOR is the interbank rate. So if a company goes to the bank to go and borrow, the bank will not give the loan to that company at the LIBOR, because that bank itself will go and borrow from another bank, will borrow money at that LIBOR. So when they borrow at the LIBOR, when you come in, they would have to add something to the LIBOR to cover for their profit and also to cover for the risk they are going to take. If you remember, we said the cost of capital will reflect the base rate plus the risk premium to compensate for both business and your financial risk. And any risk premium in this case, they might call it what is called a spread. So if I have to borrow, my cost of debt can be calculated as the LIBOR. This is what the bank is actually borrowing at. They are not going to give me the loan at that rate. They will definitely add something. What they will add is what we refer to as what? The spread. That's their profit element. And that profit element will be in relation to a return to compensate for your business risk and your financial risk. Okay, so that is the argument. It's just the same as we saying the risk-free rate plus a risk premium to compensate for business and financial risk. So this is how we can calculate the cost of debt. So the examiner might say that that company borrow at LIBOR plus, let's say, 50 basis points. What has he said? I'm borrowing at LIBOR plus 50 basis points. This is the way we can also calculate the cost of debt. So 50 basis point, what is the meaning? When we say basis point, it is referenced to 100. So when I say 50 basis point, you divide this by 100. This is LIBOR plus 0.50%. So instead of the examiner saying you borrow at LIBOR plus 0.5%, he might say it LIBOR plus 50 basis point. When I say 60 basis point, I'm referring to 0.6%. When I say 200 basis point, I am referring to this divided by 100. So I'm referring to 2%. So whatever basis the examiner will give to you, divide it by 100 and bring a percentage. So that is the meaning. So this is one way the examiner can test you how to calculate the cost of debt. Let me also illustrate something. Sometimes instead of giving you the LIBOR plus your specific spread, they might link it with what is called your credit rating. And credit rating will be used to group your company into, is it AA plus, or is it B plus, or is it C? So the examiner might say that, okay, you borrow at LIBOR plus your spread, and your spread is based on your credit rating, and he will give you credit rating, let's say AA, let's say BB for the sake of argument. But your company is a BB red. So they will tell you the credit spread for AA is, let's say, 100 basis point. The credit spread for BB is, let's say, 130 basis point. Therefore, if I borrow at LIBOR plus the spread and my company is a BB rating, then my company's cost of debt will be the LIBOR rate, whatever it is, plus the BB rate, which is 130 basis point, and that 130 basis point will give me 1.3%. So if LIBOR is 10% for the sake of argument, then my cost of debt is going to be 11.3%. I normally see this approach to be very easy, but most often when they go through, the students are not very familiar. They are always thinking about the internal rate of return calculations and all that. That is why I am trying to bring your mind on this. So now let's go to the note and I pick it from there. Okay, before I go there, when we are hedging interest rate, we are going to protect it against movement in what? Exchange rate. Remember, movement in the interest rate, movement in the interest rate. So the movement in interest rate, look at it. We are not hedging against your spread. Your spread is reflecting your business and financial risk. That is you. What they are hedging against is they are hedging against the LIBOR. Because look at what we just did here. If my LIBOR is 10%, 10% plus the spread will give me the 11.3. If LIBOR goes to 11%, here will give me 12.3. So the more the LIBOR moves, the more you are likely to pay more or less. And as such, we don't protect you against the spread. We protect you against what? The LIBOR. Because the questions coming, this is where some people get confused. Why are we not protecting all the interest rate that we are paying? We are not protecting against your spread. We are protecting against your LIBOR to get the movement in there. Okay, so let's go straight and we go and pick certain things to illustrate. Term structure of interest rate. Nobody specifically is going to ask you to define this, but we are leading ourselves to something different. Term structure of interest rate shows the relationship between how much return or interest you're supposed to pay on the debt with reference to the number of years or the period. The term of a particular debt is the period of the debt. So what is the relationship between the interest you're paying and the period of the debt? As we might all know, the longer the period, the more interest we are supposed to pay. Because the longer the period, the more likely, holding everything constant, the more likely it's risky. And there is this trade-off between risk and return. So the term structure of interest rate shows the relationship between interest and the period of the maturity of the debt. And that is what is represented on what is called the yield curve. So normal yield curve is showing you this. It's positively sloped like that, telling you that if the debt is 5 years, this is the interest or return you would have to pay. If it is 10 years, this is what you have to pay. So common sense here is that the more longer period the debt is, the higher interest you are supposed to pay to the person who gave you the money. And of course, the more return the investor is also going to have. However, we've also got what is called inverse yield curve. I will bring you back. Inverse yield curve or adverse yield curve, okay, or somebody will say abnormal yield curve. The abnormal yield curve is telling you that abnormally, the shorter the period, the higher will be the interest rate. So if it is 5 years, this is what you're paying. If it is 15 years, you're paying less in the abnormal situation. So holding everything constant, the longer the period, the higher should be the interest rate you would have to pay. But there's abnormal. What explains the shape of the yield curve? What explains this shape being normal or abnormal is what is explained by these theories. So the shape of the yield curve is explained by what is called the liquidity preference theory. Liquidity preference, liquidity, when I say you are liquid, it means you have got cash on you. So investors will normally prefer liquid cash. They want to keep money on them. So if you want them to give the money to you, then you are depriving them from their liquidity preference. That's why the theory comes in. They prefer to have money. Therefore, on them, if you want them to give the money to you, you are depriving them from what they prefer. So under what circumstance will they be prepared to give you that particular money for a longer period? They are making that sacrifice unless you are prepared to compensate them by giving them a higher return. So if you give me a higher return, then I will consider to go away from my preferred liquidity preference I will need to keep, and I will give the money to you. So the longer you will keep my money, the more you are depriving me, and the more I will be prepared to charge you a higher return to compensate for whatever sacrifice I am making for you. That's why you see the yield curve showing positively, meaning that the longer the period, the higher should be the interest rate. Expectancy theory. The expectancy or the expectation theory is saying that the shape of the yield curve explains how the market expects the future interest rate to move. If we are expecting or if the yield curve is positively sloped like this, then it means the market expects that long-term interest rate are going to be increasing. Therefore, when you are thinking about your investment strategy, you can just look at the yield curve. If it is positively sloped, then you are expecting interest rate to increase in the future. If it is abnormally sloped, which is negatively sloped, then it is expected that interest rates are supposed to decrease in the future. So that is that. And the last one is the market segment theory. Technically, if you have seen a yield curve from any financial papers, you will actually appreciate that it doesn't go smoothly like this. It goes something like that. Okay, it's not smooth like that. Okay, so normally this market segment theory is what is explaining the bombs in there. Okay, and what are we saying? The lending and borrowing market are divided into two. We have broadly what is called the long-term borrowing market or lending market, and then short-term. For instance, the bank manager has to give overdraft for short-term. They might have to give mortgage for a long-term. If interest rate is good for short-term, the bank manager will still continue to give the overdraft and long-term. It's not likely to move. So there's a segment they are in, either long term or short term. But naturally, in that market, The moment short-term interest rate is good, you will see small greedy. I would have to use that word for the sake of argument. You will see small greedy investors who might want to move from long-term to short-term in order to go and enjoy the higher interest rate in the short term. The same way, if interest rate in the long term is good, you will see some small investors moving from short-term segment to the long-term segment in order to go and enjoy the benefit that is actually accruing on the long-term basis. And that movement is what is bringing these bombs and all that. So when you go to your note, you see that the market segment, they're going to tell you the harms, the wiggles, the dips and all that. That is in the curve. All the shape, those small movement is as a result of what? Investors moving between the short term and the long term, moving between those segments. That's why they call it the market segment theory. Okay, what is the significance of the yield curve to you? The significance of the yield curve to you is simply that you can look at the yield curve and you come out with your financial strategy or your investment strategy. If I am going to borrow in the long run, or I'm going to borrow for a very long time, and I see the yield curve as something positively sloped like that, it means the market is expecting long-term interest rate to increase. So when I am going to borrow for long term, I do not have to borrow at a variable rate. When I borrow at floating or variable rate, and the interest rate actually increases in the future, I will be called upon to pay more. So in that case, it will be better for me to borrow long-term fixed, so that when the interest rate increase, I am still at the fixed rate. I'm not bothered about it. The same way, when I see the yield curve negatively sloped like that, I should be able to know my investment or my borrowing decision. If I am going to borrow, I have to borrow long-term what? Variable. Because interest rate is expected to fall. So that if I am on variable and the interest rate falls, I will take advantage by paying what? Less. So that is the argument. You can opposite it for simply if you are going to invest. For instance, if I'm going to invest and then interest rate is expected to what? Decrease. So if I expect it to decrease, I will invest and I will get what? A fixed rate. So that when it decreases in the future, I'm still on the fixed. But if the interest rate curve is positively sloped like that and I'm investing, obviously I want variable, so that when the interest rate increase, I'll be able to get more. Okay, so that is the argument. All these I have explained. The examiner is not likely to tell you, explain what is yield curve and the shape of the yield curve. That is F9. P4, the examiner is going to help you using the yield curve to calculate the value of a company. So let's see something. Bond valuation and bond yields. Chapter number 9, we learn something called bond valuation. The value of a bond is the present value of the interest and redemption value using the cost of debt. And they are using a type of bond here called plain vanilla bond. When you see plain vanilla bond, don't run away. It's the normal bond you know. The normal bond we know, when I get that bond, I will receive interest year 1 up to the end of the period. And then at the end of the period, I will get my redemption value. The technical name is the plain vanilla bond. We've also got a complex bonds here, where that bond we will be paying or the amount, we won't get interest and principal, but the amount will be paid in equal installment. The amount being paid in equal installment, that installment part goes to interest, part goes to principal, and by the time of paying the last installment, total interest, total principal, everything is gone toward zero. So plain vanilla bond, or any bond that you want to calculate its value, is the present value of the cash flows that goes with it. But the cash flows associated with plain vanilla bond is that every year I would have to receive interest, and then the principal will be paid at the end of the maturity. So let's take this example to illustrate. A company has has issued some 9% bonds which are redeemable at par in 3 years' time. Investors require an interest yield of 10%. What will be the current market value of £100 of the bond? What will be the current market value of £100 of the bond? This is a normal bond. I will be receiving interest of what? 9%. Interest is a percentage based on the nominal value. If nominal value is given to me as 100, 9% of 100, forget about this net, 9% of 100 will give me 9. Every year for the next 3 years, every year I'm getting interest of 9. And come the end of year 3, I will get the redemption value of 100. The cost of the debt is given to me at what? 10%. So I will discount it at 10% because I did 1 to 3. I need annuity. And that annuity factor of 10%, 1 to 3 is 2.487. Multiply. And then present value 10%, 3 years. You multiply. This is the value of the bond. This is not where I'm interested per se, because this is the normal way of calculating the value of the bond. We are leading you to something else. Gross redemption yield or yield to maturity or required rate of return. We said when we have a redeemable debt, the cost of the redeemable debt is calculated using internal rate of return. Alternative name for internal rate of return is redemption yield, yield to maturity, required rate of return. So many names. But the common name we tend to use is that internal rate of return. We did it when we did cost of capital. So let's use this to refresh our mind. A 5.6% bond is currently quoted at 95x interest. It is redeemable at the end of 5 years at par. Corporation tax is 30%. Calculate gross cost of debt. Because they want gross cost of debt, this tax figure, I don't need it because the question specifically says what? Gross. So what will I do? All what I'm going to do is that to calculate the internal rate of return, I need my what? Cash flows, number of years. So the debt is for how many years? 5 years. So I open year 0, 1 to 5 and 5. We've done this already. That's why I'm leading you through. I need to get the ex-day market price, ex-interest market price of the bond, which the question said the market price is what? 95 ex-interest. Every year, I have to get interest of 5.6. 5.6 of nominal. If they don't tell you, you assume is 100 of the currency. 5.6 of 100. Because they want the gross, I am putting the gross figure there, which is going to give me 5.6. Redemption date, I have to redeem the 100. And then I will have to assume my own two rate. They assume 10% and 5%, and they got internal rate of return of 7%. Meaning the return or cost of that debt is equals to what? 7%. These two things that we've done them in the past. Now, what we have to learn here is what we are now to do, which is valuing bonds based on the yield curve. Okay, how did we calculate the value of a bond? For instance, here we said the value of the bond is the present value of the future cash flows discounted using what? The cost of the bond. The cost of the bond, we calculated it as what? 7%, which is internal rate of return. This 7% internal rate of return, if this bond is 5 years, does it mean every year you will get 7%? It doesn't mean that. That internal rate of return of 7% is basically the average return you will get over the 5-year life of the project. But bonds of the same class, as I showed you when we're doing the BB and the AA plus and all that, bonds of the same class or debt of the same class will have the same return. Because bonds of the same class, the classification is done based on the level of risk. So when we say this bond is classified as AA, it means all other bonds classified as AA will have that similar risk. And if they will have that similar risk, they will have that same classification, and as such, their return should be the same. So when I draw a yield curve for you like this, when I draw a yield curve like this for you, and I say that this is the bond of class AA, it means all bonds with AA will have this return. This is the return, and this is what? The period. Okay, so if this is year 1 and this is, let's say, 2%, year 2 this is 3%, year 4 this is 4%, for the sake of argument, year 2, year 3 here. Okay, what will be the cost of this bond AA? Is the internal rate of return. That internal rate of return is not any of these, because that internal rate of return is the weighted average of the 4%, 3%, and 2%. It's telling you that in such bonds, if the bond is for a period of 1 year, the true return you will make on that bond is 2%. 2 years, the true return you will make is 3%. 3 years, the true return you will make is 4%. So over the life of the bond, what is the weighted average return? That weighted average return is what is referred to as the internal rate of return. At F9 level or even at P4 level, some of the questions, they just give us the internal rate of return. We use it to calculate the market value of the bond. When you go to the exam room and the examiner gives you a yield curve and he wants you to calculate the value of the bond, then you would have to respect that, because the value of the bond is the present value of the future what? Cash flows discounted using the cost of the bond, and the cost is the same as return. So cash flow in year 1, I cannot discount it at internal rate of return, because year 1 I didn't make internal rate of return. Year 1 the return I made is 2%. Year 2, the cash flow in year 2 should be discounted at the return in year 2, which is 3%, and then cash flow in year 3 should be discounted at 4%. Okay, so what we did in the F9 and all those cases, it was based on the average. That is fine. So when you go there and they give you the yield curve, please respect that. So that is what brings us to this, valuing bonds based on the yield curve. So let's take this example. A company wants to issue a bond that is redeemable in 4 years for its par value or face value of 100 and want to pay an annual coupon of 5% on the par value. Estimate the price at which the bond should be issued and the gross redemption yield. We are using this to establish the meaning of what I've said. The annual spot yield curve for a bond of this risk class is as follows. Year 1 up to year 4, those are the interest rate. As long as this bond falls within the same class, bonds of the same risk class are supposed to have the same return. So this bond, year 1, because it also belongs to this class, year 1, this is the return. Year 2, year 3, and year 4. What will be the value of the bond is the present value of the cash flows discounted using this respective word, interest rate. So what am I going to do here? Straightforward. I will say what will be the years that bond is supposed to go. According to the question, it's supposed to go for 4 years. So I'll say year 1, 2, 3, and then what? 4. What will be the cash flows? The cash flow is every year I will receive interest, and come the end of the period, I will receive the interest plus the principal. Here you cannot use annuity. Why? Because it's not 1% you're going to use. Every year the percentage is going to change according to the yield curve percentages. So when we come to the question, the bond is having a coupon interest rate of 5%. The nominal value of the bond is 100. Interest is a percentage based on the nominal value. 5% of 100 will give you what? 5. So year 1, 5, year 2, 5, year 3, 5. Year 4, I will receive 5 and I will also receive the 100. So this one will be 105. Okay. what will be the discount factor? Normally, we would have used the internal rate of return to finish it. But as I said, that internal rate of return is the average rate, But once the yield curve is given to us, it means we have access to every year's rate. So every year cash flow will be discounted using that year's rate. Year 1 is 3.5, year 2 is 4%. So when I come here, I will say year 1 is 3.5 and 4% there. So here will be, we all know how to calculate discount factor as 1 divided by 1 plus r raised the power n. So this will be 1 divided by 1.035 raised the power 1. The second rate is 4%, 1.04 raised the power 2. What is the third rate? The third rate is 4.7 and 5.5. So this is 1.047, 1.055. Let me be sure of that. Okay, so I raise the power that. This is raised the power 3 because 3 years. This is raised the power 4. And what will be the present values of those figures? So I will say 5 divided by 1.035, and this is 4.83 PV. So it's the same principle. The only difference is that we are not using the common internal rate of return. We are using the return specific for each year. So 5 divided by 1.04 squared, and that is giving 4.62. Then 5 divided by 1.047 cube, and that is giving 4.36. And then 105 divided by 1.055 raised the power 4, and that is giving 84.76. So the market value of the bond, or the market price, will be the 4.83 plus 4.62 plus 4.36 plus 84.76, and that is giving 98.57. That's it. So when they give you the yield curve, don't run away. Every time this type of question comes, students don't do them, because the moment they saw the yield curve, they are running away. All what is telling you is that bring the yield curve rate for each year specific to each year's cash flows and discount it. Okay, so that is why they got this figure here for you. And then question is also telling me to calculate the cost of the debt, the average cost of the debt. That's why they said gross redemption yield. My gross redemption yield is the internal rate of return. To get the internal rate of return, I need the market price in year 0. That is what we've calculated here. Year 1 to year 4, I will get my gross interest. And then year 4, I will get the redemption value. I pick 2 rates, assume myself. So here they pick 5% and 10, and they got internal rate of return of 5.46%. And this is why we told you that the internal rate of return is not the rate you get every year. The rate you will get every year is this, and that. The weighted average of this is what is giving you the internal rate of return. So when you get the internal rate of return, you've seen that is 5.46, but there is no interest year rate, which is what? 5.46. Okay, sometimes the examiner might ask you a question, why the internal rate of return or the gross redemption yield is closer to that. Okay, this is 5.5, but the average rate is 5.46. Why is it closer? It is closer because majority of the cash flows occurred in what? Year 4. Look here, 105. Therefore, the more weight, that's why we said is the weighted average. The more weighting, here is 5, 5, 5. This is 105. The more weighting is associated with what? Year 4. And as such, the average return will be moving towards the year that is having the higher or the more weighting. That is why it's equals to the or closer to the 5.5. So that is it. That is basically that. Okay, so when they tell you to calculate the market value using yield curve, it's not an issue of running away. Okay, the examiner tested this some time back. He reversed the whole argument. If I have given you the market value, or let's say I have given you the cash flows, I have given you this yield curve rate of 3.5, and I told you to calculate the market value, you will say the market value is the present value of the future cash flows. So if the market value is this, now I've given you the cash flow, I've given you the PV, and I asked you to calculate the yield curve, which is the rate. Will you be able to calculate that? The simple argument is, given any two, you should be able to get a third one. So when I give you cash flows and I give you the yield curve, you should be able to get a present value, which is the value. When I give you the present value, I give you the cash flow, you should be able to get what? The yield curve. So the examiner turned the question, and that example is what we are putting in here. So let's use this example to illustrate. A government has 3 bonds in issue that all have a face or par value of 100 and are redeemable in 1 year, 2 years, and 3 years respectively. Since the bonds are all government bonds, let's assume that they are of the same risk class, telling you that as long as they are of the same risk class, all of them will be subject to the same return. Okay, because there's this trade-off between risk and return. Let's also assume that coupons, which is the same as interest, are payable on an annual basis. Bond A, which is redeemable in years' time, has a coupon rate of 7% and is trading at 103. So they've given us market value of bond A, they've given us interest of bond A. They want us to determine the yield curve. Same way, bond B, which is redeemable in 2 years, has a coupon rate of 6% and is trading at 102. Bond C, which is redeemable in 3 years, has a coupon rate of 5% and is redeemable at 98. Determine the yield curve. Okay, so when they give you this and the examiner wants you to determine the yield curve, then the simple argument is you need to reverse things. The value of bond A will be calculated as the present value of the cash flows that goes with it. So when I go to bond A, I am going to say that bond A, how many years are you going? Question says bond A is going for only 1 year. What will be the cash flow? I would have to get the interest plus the redemption value because everything is happening only 1 year. Interest rate on bond A is 7%. Nominal value is 100. 7% of 100 is 7. And when I get the 7, I will also redeem it that same time at the end of year 1, which will be 100. So year 1, I will get cash flows of 107. What will be the discount factor? This is what I don't know and I'm looking for. This is what I don't know and I'm looking for. So I don't know that. But we said it should be 1 divided by 1 plus R. This is N. N here means 1 year. And when I find this one should give me the PV. I am teaching. That is why I'm illustrating it that way. So therefore, what are we going to do here? What we're doing here is that the market value, which is the PV, should be calculated as the present value of this. So in the exam room, I will go straight and say the market value of bond A, which is 103. So I'll say 103 should be calculated as the cash flow of 107 divided by 1 plus R raised to the power 1. And I'm going to look for that R. What will be the R? This one is divided by 1. You cross multiply. So 1 plus R raised to the power 1 should be equals to 107 divided by 103. And how much will it be? 107 divided by 103 will be 1.0388. This is 1 plus r raised to the power 1. So what then will be my r? Is it 1.0388 minus 1? And that will give us 3.88 sort of. That will give me 3.88. So that is the return on this bond for year 1. I go to bond B. If I go to bond B, what is happening? And bond B. With bond B, let's go and read. Bond B, which is redeemable in 2 years, has a coupon rate of 6% and is trading at 102. Okay, and it's trading at 102. So the market value will be the present value over the 2-year cash flows, isn't it? So when I come here, I will say the market value of the bond 2, which is 102, that 102 should be equals to present value of year 1 and then what? Year 2. Year 1 cash flow will be the interest. So bond B, what is your interest? Is 6%. 6% of the nominal value of 100 should give me 6. And year 2, I will get the 6 and I will redeem it at 100. So when I come here, I will say this is 6 and this is what? 106. I need to discount them. How will I discount them? I need to discount them using the yield curve. But point of attention, be with me. This is what people mix. Point of attention. As long as bond A and bond B are of the same class, they will be entitled to the same return. So if year 1, bond A is making a return of 3.88%, then bond B will also have the same word return to think about. Okay? So therefore, we are going to say bond B, year 1, you will make the same return as bond A made. So 1.0388 raised the power 1. If we come to year 2, we don't know. So we'll say 1 plus R2 squared. Okay, so that is what we're doing. And as such, we solve for the R2 mathematically. So I'll say 102 should be equals to 6 divided by 1.0388. And that will give me, is it 5.78 plus the 106 divided by 1 plus R2 squared. This one will go. You need a bit of primary school arithmetic. So this one will cross. So 102 minus 5.78 should be equals to 106 divided by 1 plus R2 squared. So 102 minus 5.78, and that is 96 is equals to 96.22 is equals to 106 divided by 1 plus R2 squared. We need bit of primary school algebra. Okay, and then we solve this. This is divided by 1. So 1 plus R2 is equals to 106 divided by 96.22. This is squared here. Okay, so I'm going to have 1 plus R2 squared should be equals to 106 divided by the answer there, which is 1.10164,207. And then be with me, because this is squared and I have to remove the square there, I have to take the square root of the other side. So 1 plus R2 will be equals to square root of 1.10164,207. So what then will be R2 there? So when I find the square root of the answer, that will give us 1.0495. Therefore, my R2 will be 1 0.04959 minus 1, and that will give me 4.96 what percent. So this is the R2. We have to do the same thing for bond C, and we will get year 1, year 2, year 3, and that is the yield curve. So now let's go and look at bond C. Let's go and look at the bond C. What is bond C saying? Bond C, which is redeemable in 3 years, has a coupon rate of 5% and is trading at 98. And is trading at 98. Okay, so we find the present value over the 3 years of the cash flows. Coupon rate is 5%. 5% of the 100 is 5. I will receive 5 year 1, year 2, year 3, and year 3 I will also receive the redemption value. Market price is 98. So I will say the 98 was got as the present value of year 1, year 2, year 3 cash flows. And because the coupon rate is 5, this is 5, 5, and this is 105. Bond A, B, C, D. A, B, C, all of them are having the same risk class. So all of them should have the same word, return. So year 1, return from bond A, which is 3.88, should be brought here. So 1.0388 word, raise the power 1. Return from bond B in terms of R2 is giving us what? 4.96. So here will be divided by 1.0496 word squared. Then I will say 1 plus R3 raised the power word 3. So I solve it mathematically. 98 is equals to 5 divided by 1.0388, and that will be 4.81 plus 5 divided by 1.0496 squared, and that is 4.5 word 4, and this will be plus 105 divided by 1 plus R3 cube. So these two will move to the other side. So 98 minus, when I sum these two, 4.81 plus 4.54, that will give me 9.35. And then it's equals to 105 divided by 1 plus R3 cube. So when I find the difference, minus the 98 is giving me 88.65 is equals to 105 divided by 1 plus R3 raised the power 3. So what should I do? This is divided by 1. Cross multiply. So I will say 1 plus R3 cube is equals to 105 divided by 88.65. So 1 plus R3 cube should be giving us 105 divided by 88.65, and that is giving 1.18443 and so on. But because this is cube, then I would have to find what? The cube root. This is cube. So I would have to find the cube root of the other side. So 1 plus R3 should be equals to the cube root of 1.18443. So 1 plus R3 should be giving us, I find the square root, cube root of that. So that raised the power 1 divided by 3, and that is giving 1.0580. So what is the R3? Is simply going to be 1.0580 minus 1, and that your R3 should be giving us, R3 should be 5.80%. So what then is your yield curve? My yield curve will be that year 1, okay, year 1, the return is 3.88%. Year 2, return is 96%. And then year 3 is going to be the 5.80%. So either the examiner will give you the yield curve to calculate the market values, or he will give you the market value to calculate what? The yield curve. Okay, I've got only 8 minutes here. What I'm going to say here is that whatever is not done here, it doesn't mean you're not supposed to do that, because that's why you have access to those recorded videos. Have a go through them. It's just like me standing there talking to you now. I've recorded all of them. Have a go through them. Any questions that you would have to get, send them through the email and I'll be very happy to answer them for you. Okay, so I'm going to use the 7 minutes because some of you might not, I'm not sure. I will encourage everybody though to come for the revision. Okay, but once we are ending this episode of the lecture, I have to put you to the exam room. And in the exam room, what are you basically supposed to do? Okay, before you are going to the exam room, you have to make sure you have reasonably read through the syllabus across board, because I've already indicated that the problem with P4 is not learning chapter by chapter by chapter, that I've understood chapter number 1, I've understood chapter number 2, I've got chapter number 3. No, that is not the case in P4. The case with P4 is a given question will expect you to display understanding of different topics areas. So what I normally tell students is this: you have to know the interrelationships between the topics. If I'm learning investment appraisals, I have to link it to cost of capital, because to get my MPV, I will need a discount factor. And to get the discount factor, I will need WACC. What WACC will I need? The WACC I will need should be dependent on the project specific WACC, or is it my normal WACC? It will be project specific WACC if the new project is a diversification away from my main activity. If it is an expansion of an existing project, then it's going to what? Be based on the current WACC. So you need to be able to link that. If I'm doing international investment appraisals, I have to link it with cost of capital. I also have to link it with exchange rate, because I have to determine exchange rate either using the purchasing power parity or the interest rate parity, which we've done them. So it's the links that you would really need to consider. You do not have to just learn them individually. As we were doing the APV, if you remember, I gave you that broad word template, because that APV, when I have to get the net cash flows, where did we learn the net cash flows calculation? We did it in chapter number 2. And then when you get the net cash flows, you need the cost of equity and geared. Where did we do that? To get the cost of equity and geared, you need Miller and Modigliani. Am I supposed to go using the prepositions? Am I supposed to go using the beta? The beta approach was learned in CAPM, which was chapter number, if I will remember, I think chapter number 7 or chapter number 6. Okay, and then the Miller and Modigliani prepositions, we learned that in chapter number 5, before APV was in chapter number 7. So that chapter number 7 per se, you have to go to chapter number 2, come to chapter number 5, come to chapter number 6 before you'll be able to do the whole question on what? APV, which in itself is chapter number 7. So this is the interrelationship I will expect you to display whilst you are learning. So don't learn them individually. I agree that the initial stage, you learn that chapter as it is, and then when you understand the chapters, ask yourself how this chapter interrelate to other chapters, so that I will be able to know it straightforward. When you go to the exam room and you are solving the questions, I normally tell students, don't be too glued to the scenario there, because when you keep reading the scenario and reading the scenario, the examiner might succeed you, taking you off the principle. So when they ask me to calculate something in a requirement, my starting point is, how is that thing supposed to be calculated? Concentrate on the requirement first. get what the requirement is asking you to do and ask yourself, how is that thing done? Let me use like APV again. If the requirement says, Fred, calculate APV, I won't go to the scenario first. I will go to my principle. How is APV calculated? Okay, APV is calculated using base case NPV. Okay, and the base case NPV is the net cash flows discounted using cost of equity. When I finish, is plus or minus present value of finance effect. Finance effect will be issue cost, tax savings on interest, and then subsidy. That is what I will picture before I will come to the scenario. So when I come to the scenario, reading the scenario, I have got specific questions. I need certain things. I need the net cash flow. So when I come to the question, I'm saying you have asked me to calculate APV. And to calculate the APV, I need net cash flows. The net cash flows, where are you? And you see the question telling you straightforward. Net cash flows, this is your sales and your selling price. This is your unit. This is your selling price. This is the selling price inflation. Oh, to get net cash flow, I need sales, variable cost, specific fixed cost, tax and tax savings on capital allowance, working capital, initial investment, residual value. That will give me a net cash flow. So when I come, where is your sales? Where is your variable cost? Where is your specific fixed cost? Where is your tax? Where is your tax savings on capital allowance? Where is your working capital? Where is your residual value? Where is your initial investment? You will see the question giving you the answers like that. Okay, I've got the net cash flows. I have to calculate what? The cost of equity and geared. I go to the question. To calculate APV, I need cost of equity and geared. How do you want me to calculate it? Do you want me to use the preposition to because you have given me cost of equity? Or do you want me to use preposition 3 because you have given me WACC? Or do you want me to use the beta approach? The question will give you the answer. You don't go to the question for the principle. You go to the question with the principle so that the question will feed you back with that particular principle what you need for the principle. Because don't forget, the examiner is going to what? Set the question in line with those principles. Therefore, if you go to the principle and you come to the scenario, you see the scenario ready to give you the figures that you want. So cost of equity, okay. Read the question, ICO, beta, okay. Question is telling me I've given you a beta, can't you see? So indirectly, I'm telling you to use the beta approach. Okay, the beta approach, what should I do? It should be proxy beta and gear and put it in CAPM. So I'm going to take the beta. When I take the beta, I ask, that beta, are you geared or ungeared? If the beta is ungeared, then there is no need for me to ungear it again because it's done for me. If the beta is geared, my principal is telling me I need to ungear. So I will ungear. Then I put it in the CAPM. Then I go, where is issue cost? Where is this? Where is this? You will end up, where is this? Question answer you and you answer it. So the principle to go to the exam room is simply make sure you have got the principles of the topics here and you lead yourself. Get a framework of doing everything. If it is international investment appraisals, I have to generate what? The cash flows in the currency in which the project is undertaken. So if I'm going to do the project in Germany, my understanding is I have to first generate all the cash flows in the euro. So where are the cash flows? I go and look for them. Then when I get all the cash flows in euro, I have to convert it into my home currency. I will need exchange rate. Question, where is the exchange rate? If the question had given me the exchange rate, so be it, I pick it. If the question don't give me the exchange rate, when you go and ask for it, it will tell you, I haven't given it to you because you don't see them. So I'm expecting you to do it. Okay, if you are expecting me to do it, how? Do you want me to use the purchasing power parity or do you want me to use the interest rate parity? Question will tell you, don't you see I have given you inflation rate? Or don't you see I've given you interest rate? So if they've given me inflation rate, then the question is telling me indirectly, you would have to use that your purchasing power parity. Or they've given me interest rate, so you would have to use that interest rate parity. This is how I solve questions, and this is how it's going to make life very, very easy for you. Otherwise, you see people reading the scenario over and over and over to get the clue. The clue will never come out unless you have come to the scenario with the principle that this is what I need. The moment you ask the scenario, this is what I need, either the examiner will give it to you directly. If he doesn't give it to you directly, ask the question again. If you haven't given me this, it means you are hiding it. How do you want me to bring it? Then you see the scenario giving you an alternative. Okay, so our time is up. What I'm going to say is, make sure you solve more and more and more questions. As you can see, the current examiner is repeating most of the questions. If you look at the June exam, all the questions were repeated. All the questions were repeated questions. So make sure you go through questions over and over. I've said it before. Some of you have already requested. If you haven't yet requested the must, the should, and the could questions, you still have the facility. You can send them through email, and I'll be very happy to send them to you. If you go through those questions over and over, you see a pattern, and as such, you'll be comfortable. So thank you very much, and go through the videos. Any problems that you have, you send them to me. So thank you very much, and hope to see you during the revision. Thank you.